Hi everyone and welcome to the first video on this channel. My name is Nakul Anand and in today's video we're going to go through how to invest money safely and efficiently in your 20s. Over 50% of us under the age of 30 don't invest in the stock market because there's this perception that if you invest in the stock market, you could lose a lot of money because investing is risky and you need a lot of experience and knowledge before you start investing. But as long as you follow some simple rules, this isn't true. And all these rules center around one thing.
Dogecoin. Look at Dogecoin. Meme-based cryptocurrency, Dogecoin.
No, but seriously, all these rules center around long-term investing. This may not sound as interesting, but at least you won't lose half of your hard-earned money in a month. Long-term investing drastically increases the chances of you making money in the market, allows you to grow your money exponentially over time, lets you invest in riskier assets, and cost less. If you watch this entire video, you'll see that it's amazing how such a simple concept can have such a beneficial impact on your portfolio's performance and drastically reduce the chances of you losing money in the market. Let's get started. There's this saying that time in the market always beats timing the market. What that means is you'd rather invest early and stay invested rather than waiting for the stock market to fall and buying the dip. That's because buying the dip isn't practical. In the short term, markets are volatile and irrational, and it's impossible to predict whether they're going to go up or down. On top of this, timing the market is stressful and goes against basic human emotion. But in the long term, markets always trend upwards. The longer the time you stay invested in the market, the higher are the chances of you getting a positive return. Let's look at this graph created by Goldman Sachs Asset Management that takes data points of the S&P 500 from 1969 to 2018. And it shows you the chances of you making money in the S&P 500 depending on how long you were invested. The S&P 500, by the way, is a really famous index that tracks the performance of the 500 largest companies in the US. If you were invested in the S&P 500 for a day, you have a 53% chance of making money. Over a week, this number goes up to 57%. And the chances of you making money keep increasing the longer the time you were invested in the S&P 500. Over 10 years, this number goes up to 95%, and over 15 years, the chances of you making money go up to 100%. Okay, so what does this mean for you? Do not invest money that you need for rent next month or for a vacation 6 months from now, because the market can fall in the short term and you will be forced to sell your investments at a lower price to pay for rent or your vacation. Invest money that you're planning to save for retirement, or at least planning to save for the next 5 to 10 years. As long as you follow this simple rule, the chances of you losing money in the stock market falls dramatically. Long-term investing is not only safe, but it also allows you to grow your money exponentially over time, because long-term investing lets you benefit from compound interest. In simple terms, compound interest is when the money your investments make you more money over time. Let's go through a simple example. Imagine you invest $1,000 into the stock market for a year and get a 10% return. That $1,000 becomes $1,100. The initial $1,000 you invested plus a $100 return. Now, instead of removing this money, you stay invested for another year and get another 10% return. This $1,100 now becomes $1,210. You get a $110 return in year 2 because the initial $1,000 you invested gave you another $100 return, and the $100 return in year 1 gave you an additional $10 return in year 2. Now, this might not seem like a lot when it's just $1,000 and over 2 years, but the earlier you invest and the longer you invest for, the greater is the impact of compound interest. Let's go through a better example. Imagine you start investing when you're 45 years old. You invest $250 every month until you retire at 60. You earn a return of 10% annually and end up with $104,000 or a return of 130%. Now imagine you start investing when you're 35 years old. You invest $250 every month until you retire at 60. You earn a return of 10% annually and end up with $332,000 or a return of 333%. Finally, imagine you start investing when you're 25 years old. You invest $250 every month and retire at 60. You earn a return of 10% annually and end up with $949,000 or an 804% return. Now, in this example, you can clearly see the benefit of compound interest. The earlier you invest and the longer you stay invested in the market, the larger is the benefit of compound interest. The beauty of compound interest is that you don't need to do anything. You just need to stay invested and let compound interest do its thing. Long-term investing also lets you invest in riskier assets because though riskier assets may be more volatile and fall more in the short term, In the long term, as long as they're good investments, riskier assets do better than less risky assets. It's the basic risk-return trade-off. You have to be willing to take a higher level of risk to get a potentially higher return. For example, if you invest in shares of Google or Apple, they may fall more than bonds issued by Google or Apple in the short term. But over the long term, on average, shares of Google or Apple will do better than bonds issued by Google or Apple. Okay, so what does this mean for you? This doesn't mean that you take all your money and dump it into the riskiest investments available. What it does mean is that if you're investing your money for the long term, you can take a larger allocation of your money and invest it into riskier assets compared to if you're investing for the short term, and therefore get a higher average return. Let's look at this graph as an example. This graph shows that if you're investing for the short term, say your investment horizon is 3 to 5 years, you have to take a larger portion of your money and put it into fixed income, which is a less risky asset. But as the investment horizon increases, you can put a larger allocation of your money into equities, which is a more risky asset. Again, this is just an example for illustration purposes. Long-term investing also costs less, because whenever you buy or sell a stock, you have to pay a trading fees, and whenever you sell a stock at a profit, you have to pay capital gains tax. Well, when you're investing for the long term, you have to pay each of these once. For example, if you buy $250 of Apple stock at 25 and sell it when you're 60 years old, well, then you have to pay for buying Apple stock once, you have to pay for selling Apple stock once when you're 60, and you have to pay capital gains tax at the end if you make a profit. On the other hand, if you're short-term investing and you buy something at 25, sell it after a year, buy something new, and keep doing this until you're 60, well, then you have to pay trading fees to buy 35 times, trading fees to sell 35 times, and capital gains tax anytime you sell any of your investments at a profit. So you can clearly see why long-term investing is way more cost-efficient than short-term investing. So in summary, long-term investing drastically reduces the chances of you losing money in the market. It allows you to grow your money exponentially over time by doing nothing except staying invested. It allows you to invest in riskier assets and therefore get a higher average return. And it costs less. Now, this doesn't mean you can invest in anything and hope that long-term investing will help you, so I will go through what you should invest in your 20s in another video. If you did find this video useful, do like the video, do subscribe if you like this kind of content, and I'll see you in the next one.